Imagine a corporation with the legal authority to declare war, draft treaties, mint its own currency, and execute its own employees. This is not a dystopian science fiction narrative, nor a projection of modern tech monopolies into a dark future. It is a documented reality from over 4 centuries ago. In 1602, a commercial entity was born that would fundamentally rewrite the DNA of global power, transforming the pursuit of profit into a sovereign force. It was an enterprise so vast, so unprecedented in its unchecked authority, that its shadow still dictates the architecture of modern capitalism. The Dutch East India Company, known by its Dutch acronym VOC, did not just participate in the global market, it became the market. Before its inception, maritime trade was a fractured, agonizingly risky gamble taken by independent merchants who routinely lost their fortunes to storms and pirates. The Dutch government, seeking to dominate the lucrative spice trade in Asia, forced these rival merchants to merge into a single, unified syndicate. By granting this new entity a government-backed monopoly, they created a financial leviathan, one explicitly designed to eliminate competition and weaponize commerce on a planetary scale. To fund this unprecedented ambition, the company needed capital far beyond the wealth of a few aristocrats. They opened their ledger to the public, inviting anyone from bakers to barons to buy a share of the enterprise. This radical act birthed the Amsterdam Stock Exchange, the world's first official market for trading corporate equity. Suddenly, the risk of a perilous voyage was distributed across thousands of investors, while the potential for astronomical returns became a public obsession. The concept of the joint stock company had evolved from a temporary venture into a permanent, immortal institution. For the citizens of Amsterdam, this financial innovation felt like alchemy. Ordinary people found themselves tethered to the fate of ships sailing thousands of miles away, their personal fortunes rising and falling with the tides of global commerce. A new class of wealth emerged, entirely disconnected from land ownership or royal decree. Yet, this democratization of investment possessed a dark, psychological underbelly. The shareholders, separated from the brutal realities of the spice trade by oceans and ledgers, demanded only one thing: consistent, ever-expanding dividends, completely blind to the methods used to secure them. Driven by the relentless pressure of the exchange, the VOC deployed a strategy of absolute market domination. Nutmeg, mace, and cloves were not merely flavorings in the 17th century. They were status symbols, medicines, and preservatives, commanding prices that rivaled gold. The company realized that controlling the supply chain was insufficient. To guarantee the profit margins demanded by their investors, they had to control the very soil from which the spices grew, shifting their operations from simple trade to aggressive territorial conquest. The unseen hand of the market quickly morphed into an iron fist. In the Banda Islands, the world's only source of nutmeg at the time, the local population attempted to maintain their trading independence. The company's response was a chilling demonstration of corporate sovereignty. Under the command of a ruthless governor-general, the mercenary forces systematically slaughtered, enslaved, or deported nearly the entire indigenous population of the islands. The pursuit of a corporate monopoly had escalated into state-sanctioned genocide, all neatly recorded as a necessary operational expense in the ledgers. This atrocity reveals the terrifying arithmetic of unchecked corporate power. When an entity is legally bound only to maximize shareholder value, morality becomes a market inefficiency. The investors back in Europe, eagerly collecting their annual payouts, were either ignorant of or indifferent to the blood spilled to secure their wealth. The corporate structure acted as a moral shield, diffusing responsibility so widely that no single individual felt the weight of the crimes committed in their name. It was the ultimate privatization of violence. The echoes of that brutality resonated through every transaction, solidifying the enterprise as a state within a state. It commanded a private army of 10,000 soldiers and a fleet of 40 warships, dwarfing the military capabilities of many European nations. The company negotiated treaties with Asian emperors, built massive fortified settlements across the globe, and operated a sprawling network of colonial outposts. It was a transnational empire answering not to a king or a parliament, but to a board of directors known as the Gentlemen 17. Behind the closed doors of their headquarters, these directors pioneered financial engineering tactics that remain staples of modern Wall Street. They engaged in massive stock buybacks to artificially inflate share prices by reducing the number of available shares. They utilized complex accounting loopholes to hide mounting debts and operational losses from the public. When independent traders attempted to short the stock, essentially betting against its success, the board lobbied the Dutch government to ban the practice, effectively manipulating the regulatory landscape to protect their own valuation. The entanglement between the corporation and the state became absolute. The Dutch government relied heavily on the tax revenues and geopolitical leverage provided by the company, creating a profound conflict of interest. Lawmakers who were supposed to regulate the enterprise were often its largest shareholders. This incestuous relationship ensured that the entity operated with total impunity, dictating foreign policy and domestic law to serve its commercial interests. The state had not merely chartered a corporation, it had been captured by one. This unchecked dominance fueled a century of unprecedented economic expansion. The VOC established a complex intra-Asian trading network, exchanging Indian textiles for Japanese silver and using that silver to buy Chinese silk and Indonesian spices. It was a masterpiece of supply chain economics, a self-sustaining loop of wealth generation that bypassed Europe entirely for its intermediate steps. The company had engineered a closed-loop global economy, maximizing extraction at every node of the network. Yet, the sheer scale of this operation required an endless supply of expendable human capital. The ships were notoriously deadly, with staggering mortality rates among the sailors and soldiers recruited from the poorest slums of Europe. Disease, malnutrition, and shipwreck claimed hundreds of thousands of lives. These men were treated as depreciating assets, easily replaced cogs in a vast global machine. Their suffering was the hidden subsidy that kept the dividends flowing to the wealthy elite of Amsterdam. Eventually, the sheer weight of its own architecture began to fracture the empire. The immense cost of maintaining a private military, policing a global monopoly, and administering far-flung colonies began to outpace the profits from the spice trade. Corruption became endemic. Officials in Asia routinely engaged in private illegal trading, siphoning off the organization's wealth into their own pockets. The ledger, once a symbol of meticulous Dutch accounting, became a labyrinth of fraud and concealed deficits. To maintain the illusion of prosperity and keep the stock price from collapsing, the directors resorted to paying dividends out of borrowed money rather than actual profits. It was a catastrophic financial shell game, a massive Ponzi scheme operating under the banner of sovereign authority. The enterprise was bleeding capital, hollowed out by internal rot and facing increasing competition from rivals, yet it continued to project an image of invincibility to its investors. The illusion shattered dramatically at the end of the 18th century. A combination of devastating wars, shifting global trade routes, and insurmountable debt finally broke the Leviathan. In 1799, the Dutch East India Company, once the most powerful economic engine in human history, was formally dissolved. But an entity of that magnitude could not simply vanish. Its debts were so massive, and its integration into the Dutch economy so deep, that its failure threatened to collapse the entire nation. The state was forced to step in. The Dutch government absorbed the astronomical debts and took direct control of the overseas territories, transforming corporate colonies into a formal national empire. This moment birthed a concept that haunts the global economy to this day: the idea of an institution being too big to fail. When a corporation intertwines itself so thoroughly with the fabric of a nation, its reckless gambles are ultimately underwritten by the public, privatizing the profits while socializing the catastrophic losses. The physical ships of the VOC have long since rotted away, but the architectural blueprint it created remains the foundation of modern corporate power. Today, transnational tech giants and global logistics conglomerates do not command private armies, but they wield a different kind of sovereign influence. They control the digital infrastructure of human communication, dictate the terms of global supply chains, and hold cash reserves that eclipse the gross domestic product of entire nations. They operate across borders, often exploiting jurisdictional gaps to minimize taxation and evade regulatory oversight. Modern financial systems mirror the complexities pioneered in Amsterdam. Dark pool trading, where institutional investors execute massive block trades away from public exchanges to obscure their strategies, echoes the secretive ledger manipulations of the Gentleman 17. The relentless pursuit of monopoly, whether through aggressive corporate takeovers or predatory pricing models, is a direct descendant of the drive to control the spice trade. The mechanisms of extraction have evolved from physical conquest to data harvesting and market consolidation, but the underlying imperative remains identical. For the ordinary citizen, the consequences of this centralized power are profoundly intimate. When a single corporation dictates the algorithms that determine what information we consume, or controls the logistics networks that supply our food and medicine, our personal autonomy is compromised. We find ourselves living inside their walled gardens, subject to terms of service that function as private laws. Just as the citizens of Amsterdam were tethered to the fate of distant ships, modern lives are intricately bound to the fluctuating valuations of a few monolithic entities. This dynamic forces a reckoning with the fundamental nature of the corporation. Is it merely an efficient vehicle for organizing capital and delivering goods, or is it an inherently expansive force that will inevitably seek to usurp democratic authority? The historical precedent suggests that when an organization is legally mandated to prioritize shareholder returns above all else, it will relentlessly push against ethical boundaries and legal constraints. The moral shield of the corporate structure continues to protect decision-makers from the real-world fallout of their strategies. Governments today struggle to contain these modern leviathans, just as the Dutch state was ultimately consumed by its own creation. The revolving door between corporate boardrooms and regulatory agencies ensures that the rule-makers are often deeply sympathetic to the interests of the regulated. Massive lobbying expenditures function as a sophisticated mechanism for purchasing favorable legislation, allowing corporations to essentially write the rules of the game they are playing. The capture of the state is no longer achieved through the promise of spice revenues, but through the vital control of technological and economic infrastructure. We are witnessing a subtle but profound geopolitical shift, a return to an era where corporate entities rival nation-states in their influence on the global stage. When a social media platform can deplatform political leaders, or a logistics giant can single-handedly disrupt international trade flows, the traditional boundaries of sovereignty become blurred. The power to shape human destiny is increasingly migrating from elected parliaments to unelected boards of directors, operating behind the opaque glass of modern corporate headquarters. The story of the Dutch East India Company is not merely a chapter in economic history. It is the origin story of the modern world. It serves as a stark empirical warning about the trajectory of unchecked commercial power. It demonstrates that the logic of the market, when decoupled from human empathy and democratic oversight, possesses an inherent tendency toward monopoly, exploitation, and ultimate systemic fragility. The ledger demands continuous growth, and it is entirely indifferent to what must be consumed to achieve it. As we navigate an economy increasingly dominated by a handful of corporate titans, the ghosts of 1602 offer a chilling perspective. The mechanisms of global finance, the strategic pursuit of absolute market control, and the devastating human cost of prioritizing profit over people were not invented in the modern era. They were perfected centuries ago on the Amsterdam Stock Exchange. Understanding this legacy is not just an academic exercise. It is a necessary act of deciphering the hidden forces that continue to shape our wealth, our laws, and our lives.